Hello. In this recording, I want to talk to you a little bit about the definition of operating cash flows. I know in prior discussions I have alluded to those, but I want to be very specific here so that you can be clear as you're developing what is and is not included in operating cash flows. The overall learning objective here is that I want you to be able to identify the main characteristics of the operating cash flows, and then using an example of your own design, be able to explain each of those characteristics. So you want to not only be able to list them, but you need to explain what they are and use an example in doing that. That way you would be in a position where, I found this before when you're working on projects or evaluations of business ideas or whatever, with people inside of companies. They are so accustomed to using accounting numbers that when you use numbers other than that, they may want to argue or challenge you, challenge you, sorry, on your decision and to not use accounting numbers. And so you have to put yourself in a position where you can explain why this is the more reasonable thing to do. So let's talk about the characteristics first. The first characteristic is that we are focused on cash, not accrual. I'll talk about that in a little bit more detail in just a minute. So accrual being accrual accounting type financial reports. We are only interested in cash flows, and they need to reflect the timing of when the cash comes in and out. That's important to the decision. They should be on an after-tax basis. They should include cash flows from investments in the operations, not just the cash flows from the day-to-day operations. They should include salvage or terminal values as relevant, and they should exclude cash flows related to financing. So let's talk about each of those one at a time. Cash flows, not accrual. So when we talk about cash flows, let's put this in simple terms for you. There's an amount of cash that you receive during a period, whether that's a month or a week or a year or a quarter or whatever it is, however wide the period is that you're going to use for your analysis. So there's an amount that you receive when you sell things. And we are only interested in a cash perspective in the amounts of cash you actually receive. We are not interested in amounts that you haven't received yet. Now, in today's world where there's a lot of credit card purchases, I want to make this clear. If you receive money, if you make sales through using a credit card, you don't count them when the credit card runs through the register, but usually the cash from those credit cards will move into your bank account within a day or two. Maybe a little bit less depending on different factors, and so that counts as cash because it still turned into cash during the period. The same thing would be true if somebody writes a check and the check clears and the money is in the cash account at that point in time. And so I'm not trying to make those kinds of distinctions as much as I am the distinction between that and somebody who buys from you on credit terms that say, they don't have to pay the money for 60 days or something like that. That's really what we're focused on here. The accrual, the cash means amounts paid during the period to support sales and operations. So we normally call that expenses. Again, in accounting world, expenses, you have to be careful that you're talking about cash expenses, not accrual expenses. And again, it's the amounts paid. Once again, I'm not so worried about, I wrote a check or I, paid it with a credit card. That's a minor distinction. But, if, for example, you buy something and the terms are, 0% financing, so you're paying no interest, and you just pay it off monthly over a year, well, that's, from your standpoint, you only have cash going out, maybe a 1/12 of that amount every month, and you need to reflect that. Now, I know separately we talked about that, that financing is not a consideration here. Well, when somebody is not charging you any interest, that's not really financing per se. That is them being willing to assume a payable, right? And so that's a little bit different in that they're not necessarily charging you interest on it. They're simply allowing you to slow pay. And since that doesn't mess with the taxes or other funding decisions and so forth, and that's something that you would want to take advantage of anytime you would want to. So if something is a payable, it's not paid out in cash yet, and you wouldn't recognize it until the period that you actually pay it. Taxes paid during the period. Again, this is probably one of the better examples where we sometimes go ahead and ignore the timing just a little bit on this out of simplicity. But typically, most taxes, most federal and state taxes, they only require you to make payments quarterly. And so while you may have a tax due amount every month, you only actually have to send cash in once a quarter. Not necessarily a big deal, but you would want to note that. Occasionally, there are situations where your tax, you may have a tax situation where you've deferred the taxes for several years. I've seen this in cases where a company has filed a dispute with the IRS and basically said, we don't think that the amount that you're asking us to pay in taxes is correct or consistent with IRS code, and we're taking you to court. And they've delayed the payment to their taxes as much as 10 years. Quite frankly, I speculate that was part of their strategy, that basically this is like getting a free loan from the IRS for 10 years. It's not really free, but low cost compared to the amount. And we're talking hundreds of millions of dollars. And so that's a pretty good deal for them. And so you want to make sure that you reflect the timing of the taxes when they're actually paid, when it's a big difference like that. A month or two probably doesn't make a difference in most cases, so you don't necessarily have to be that specific with it. But when it's years, it makes kind of a big deal. You want to include in cash the amounts that are paid during the year to purchase assets and the amounts that are received from selling assets for those kinds of assets that support operations. So we're usually talking about land, building, equipment, intellectual property, things that your operations need in order to work. And we are talking about assets, tangible sorts of things that you can lay your hands on. Okay. Whereas if we think of those same concepts from an accrual basis, there's a bit of a difference, right? If we just were to pull revenues off of an income statement from a company that reports on an accrual basis, that would include amounts that were sold during the period, whether cash is collected or not. Okay, and so it would be the difference would be sort of two different ways. One would be the difference between cash and accrual. Would show up in two different ways. Under a cash, you might collect cash from stuff that you sold before. Right, in a prior month, you might collect that cash today. It would be included in cash revenues today or cash sales today. You might also not be able to collect cash for things that you sold today, and it won't come in until tomorrow, so you would reduce for that. With the revenue, you don't do that. Expenses, amounts purchased during the period, whether the cash is paid or not. Exact same kind of issue as the revenues. On a cash basis, you may have purchased expenses, things that represent expenses 2 months ago and not pay the cash out till this month. Well, when you pay the cash, that's when we would recognize it on the cash basis. On the accrual basis, you would have recognized the expense 2 months ago, right? Now, there's even some subtleties as it relates to accrual when you're talking about cost of goods as an expense. In that case, the expenses could have been paid out months or even years ago, but they won't get recognized as an expense until they are matched, until the thing that they made gets sold. And so this is a pretty important distinction for manufacturing companies in particular, that from an accounting basis, the goal is to match the cost of making a good with the revenue you earn from selling it in the same period. And so you may have a batch of stuff that you made a year and a half ago, and you spent the money and the cash went out the door a year and a half ago, and you're just now selling it today. On an accrual basis, it would say, oh, you received the money from the sale today and you spent the money in making it today. Not true. You spent the money a year and a half ago. That timing becomes really important for manufacturing companies and for their products, and can really dramatically impact the quality of things. As a matter of fact, a lot of the investments that manufacturing companies make is to try to shorten the period of time, sort of the lead time, if you will, that they have to produce things versus when they sell, because there's so much value in trying to get those cash flows to match up with each other. Taxes, again, they're for the amounts due on an accrual basis, whether they're paid or not. Another important distinction that sort of wraps around here with taxes is that the tax amounts, if you had an interest expense, you know, for tax purposes on an accrual, sort of a typical financial statement, you would deduct that interest expense first and then calculate your taxes. And so you're including in your tax amount a benefit from having an interest expense. This is a commingling of the financing cost issue with the operating cost issue, and creates a real problem. And so there's some other things you have to do with taxes to fix this. And lastly, if you look at the income statement, or you look anywhere, quite frankly, maybe in the statement of cash flows, but you look in the income statement or the balance sheet, there is no explicit place that says, here's the amount we spent on operating assets, here's the amount we received from the sale of operating assets. It doesn't show up there, all right? And so while it's important that OCF include that, and it's important that it be, you know, on a cash basis, that doesn't show up in the typical sort of earnings statement, income statement for a company. So let's talk about on an after-tax basis, our OCFs. So the real issue here, and the reason why we do things on after-tax basis, I know after I brought up that issue of interest expense, it's really easy to say, well, all that's really complicated. Why can't we just do the evaluation based on before-tax amounts, and that way that'll sort of solve all this complexity related to depreciation and interest expense? And that was proposed. The problem basically is this. Some of your business opportunities really arise because of something the taxing authority has done that creates an incentive for you. The one that is most, I think of most commonly now, are the tax incentives related to using renewable technologies and renewable energies. There are things that a company may decide to do, projects they may decide to take on, that quite frankly would not be profitable but for the fact that they're getting a tax break on them in some way or another, or a tax credit. And so if we were to only evaluate projects on a before-tax basis, we would never consider the benefits of any of these tax breaks, and none of those projects would ever get done. So as a result, we always want to include that in our evaluation. Now, this is a little bit of a catch-22, and the catch-22 on this is that the tax rules are changing all the time. And so, you know, if there is a tax benefit that you're really relying on in order to make your project viable, you really want to be able to ensure that, you know, that you get enough of that benefit early before tax code could reasonably change, because there's that risk that if you are relying on tax benefits going out 20 or 30 years, there's really no guarantee at all that will continue, particularly if it's on something that's a controversial feature of the tax code. So while you do still need to do things on an after-tax basis, you may have to make some judgment calls about whether or not certain tax benefits will continue to exist years and years and years into the future. Including asset purchases and sales. Again, I'm not trying to bang on the accounting approach here for not including those. It is reflected in some ways in their statements. It's just important for me that you guys understand that you have to include these amounts. The logic for that comes down to this. Those cash flows that you're projecting that you could get from some new business idea, you won't get them in many cases if you don't make some sort of an investment in assets, right? Usually that involves some land, building equipment, intellectual property, whatever else. You've got to make those investments in these what we would call long-lived or long-lived, however you want to pronounce it, operating assets that are the things that help you generate those cash flows. And in fact, it's usually a big chunk of the upfront money that you require from investors to get your business started usually goes towards acquiring some of these assets. And so they also contribute to the cost of the capital, the investment capital that you have to cover. In addition to just being, having positive operating cash flows, remember you have to have extra cash flows to cover the money that needs to go back to investors. Well, the whole reason you need to give that money back to investors, at least a primary part of it, is because you took money from them. The reason you took the money is for these assets. So you got to include that in there. And at the end of the day, you do have to pay that money back in some form, right? And so in order for you, since it's the amount of the money invested in these assets plus the cost of the capital for that investment is a big part of what you want these operating cash flows to cover, or more than cover, in order for you to say that you have a good business and that your value is growing. You can't determine that without including these amounts in there. And so in order to do the evaluation using the operating cash flows, it has to include the investment amounts as well. Keep in mind that can be, it's both purchases and sales. And so sometimes your plan might call for selling an old asset and replacing it with a new one, or vice versa. You may buy the new one, then retire the old one a little bit later and sell it. And so you can include the offset between those two. And you obviously have to make sure you have the timing correct, but you can include both, and that sale will sometimes benefit your project. And then you need to include salvage and terminal values. What do we mean by salvage value? It really goes back to what we just said about these investment assets. Sometimes you purchase an asset for use in the operation of your business, and in your plan, you have the idea that either the venture will only last for a particular time, and at the end of that, you're just going to sell off all the assets. And so you may say, hey, there's an opportunity out there. If we go take advantage of it, it's probably only going to be out there for 5 years, and we need to take advantage of it, and we're going to have to buy some assets to do that. At the end of it, we're going to shut that business down, but we are going to sell off those assets, and we're going to get something back from those. Or alternatively, you may just have in a plan something that says, we're going to buy some assets, but really we need assets that are functioning at a high level. And so, let's just say it's like a fleet of rental cars. That's a good example, right? You buy the cars, you usually are only going to use them for a year or two as rental cars, and then you want to upgrade to the newer car because that's what your customers want. Well, the old cars still have value, and you can sell them off, and so you want to be sure that you reflect the fact that you can sell them off, and that becomes a salvage value for the assets. So since your project benefits from making sure that you capture the money you get from selling those assets back, you want to make sure that you capture it. The other kind of value that's sort of similar to that is what we call terminal value. It's a little bit different because it's, think of it more as figuring out how much you get from selling off the whole company as opposed to any particular asset. All right, here's where this kind of comes in. So you expect your business is going to continue for a long time. You've got this business idea that you expect is going to go on for some indefinite period of time. In finance, we would call that perpetuity, meaning let's just assume it's going to go on forever. All right, but you've only developed a forecast for maybe 5 or 10 years into the future. And so your forecast doesn't pick up the fact that the cash flows are going to go on forever. Somehow in your evaluation of your business idea, you want to pick up the value associated with the possibility that cash flows continue beyond your forecast. And so what we do very simply is we say, well, imagine that on the date that is at the end of your forecast, you were going to sell your business on that date. How much could you raise from selling it? All right. And so we use different methods to estimate what we think the value that you could sell the business for 5 years or 10 years from now are. And that way we can incorporate it into the analysis. And that's called its terminal value. So it's value at the full term of the forecast. All right. So the far end of the forecast where it terminates, we stick this value in and say that's how much you could have raised on that date 5 or 10 years in the future from selling it. Now, we'll spend some time talking about how we do this a little bit later with the time value of money concepts. But for those of you that maybe are familiar with some of this, just know that we do this by estimating. What we do is we make a simplifying assumption about how the cash flows will continue out into the future in terms of whether they'll be about the same or they'll grow or they'll decline or whatever that is. And then we use a particular present value technique in order to calculate what we think will be the present value of the cash flows 5 or 10 years from now. And we're able to get to a single number. All right. And that's called its terminal value. The last concept we want to talk about is excluding the financing cash flows. I know that we need to consider those in making the decision, all right? But here's a couple of things that are true. First of all, it's one thing to assume that you need money, financing maybe. It's another thing to start making assumptions about how much of it's going to come from debt, how much of it's going to be borrowed at this rate with this much interest, and how long is it going to be borrowed, and all that sort of stuff. Those tend to be very, very specific kinds of assumptions that if you build those into your analysis, can dramatically impact the timing of cash flows, and yet they are not really things that most businesses have control over. And in fact, even the financing department, while it has control over it, it doesn't necessarily make those decisions on a project-by-project basis. It may make it on a company-wide basis. And so we like to keep the financing cash flows out of the analysis for one reason, simply because we want to keep those two decisions separately. The other reason, more importantly, that we want to keep it out of the operating cash flows is that in the methods that we usually use to make these decisions, we already pick up the cost of financing in another way. We usually do it through a discount rate when we take things back to present value. And so if you were to include some part of that financing cost, say the interest expense, in your analysis, then also adjust for that interest expense in your discounting, you've now double counted the interest expense against the project. And so that could lead you to an incorrect decision about whether it's a good project or not. All right. Last thing, it's a little bit ticky-tacky because there is a way to sort of fix this, but interest on debt in the U.S., at least currently, is tax deductible. And so by including the interest in there, you're actually reducing the amount of taxes that you would have to pay. And it's true that you would reduce those taxes, all right? But that reduction doesn't come from your business idea. It comes from how the business is financed, all right? And so it becomes a little bit of a gameplay when people start including interest assumptions and financing assumptions they can take a project that maybe doesn't look like a very good project and make it look really good just based on the tax benefits of the interest. And that will convolute the decision about whether it was really the project was good or it's just that the availability of financing is good right now. And so we don't include the interest in the calculation. And similarly, we should not include any tax benefit associated with the interest in the calculation. So that kind of covers everything related to the operating cash flows at a very high level. There's some more things that we'll talk about related to them, but these kind of quick characteristics are the ones that you want to keep in mind. And hopefully they start to put a context around why we calculate and determine operating cash flows for a business idea in a particular way, and why that way is different than what you might do for say accounting purposes. As always, if you have questions, bring those to class. Happy to discuss this. Thanks.